Welcome. Today, we're diving deep into a very important topic: what drives the U.S. stock market. The U.S. stock market is a complex ecosystem, and if you're an investor, trader, or simply someone interested in understanding how it works, it's essential to know what factors influence stock prices and market movements. In today's lesson, we'll break it all down into easy-to-understand sections. We'll cover 8 key factors that impact the U.S. stock market, and by the end, you'll have a solid understanding of what moves stock prices and why. Economic indicators are like the heartbeat of the economy. They give us a clear sense of how well the economy is doing. Here are the most important ones. A. Gross domestic product, GDP. What is it? GDP represents the total value of all goods and services produced by a country. Why it matters: when GDP is growing, it's usually a sign that the economy is healthy, and this can boost stock prices. If GDP growth slows down, stock prices might fall as investors worry about a weaker economy. B. Inflation rate. What is it? Inflation is the rate at which prices for goods and services rise. Why it matters: a little inflation is good, showing a growing economy. But high inflation often leads to rising interest rates, which can hurt stock prices. C. Unemployment rate. What is it? This is the percentage of people who are actively looking for work but can't find a job. Why it matters: low unemployment means the economy is strong, which often drives stocks higher. High unemployment, on the other hand, is a red flag that the economy might be in trouble. The Federal Reserve plays a critical role in the stock market by controlling interest rates and the money supply. Let's take a closer look at how this works. A. Interest rates. What is it? Interest rates are the cost of borrowing money, and the Fed controls these rates. Why it matters: when the Fed raises rates, borrowing becomes more expensive for companies, which can reduce profits and hurt stock prices. Lower rates, on the other hand, encourage borrowing and can fuel stock market growth. B. Quantitative easing, QE. What is it? QE is when the Fed buys government bonds to increase the money supply. Why it matters: this increases liquidity and can lead to lower interest rates, which encourages more investment in the stock market, driving stock prices up. Corporate earnings give us a direct look at how well individual companies are performing, and these reports can have a big impact on stock prices. A. Earnings per share, EPS. What is it? EPS is a company's profit divided by its outstanding shares. Why it matters: if a company reports strong earnings, its stock price will usually rise. If earnings disappoint, expect the opposite: investors might sell off their shares. B. Revenue growth. What is it? Revenue growth measures how much a company's sales are increasing. Why it matters: consistent revenue growth is a positive signal for investors, driving stock prices up. Geopolitical events. Global events can introduce a lot of uncertainty into the stock market, causing swings in stock prices. A. Trade wars and tariffs. What is it? These are conflicts between countries that restrict trade through tariffs or other means. Why it matters: trade tensions, like those between the US and China, can disrupt global supply chains and affect corporate profits, leading to volatile stock prices. B. Elections and political changes. What is it? National elections or policy changes can create uncertainty. Why it matters: political instability can make investors nervous, causing stock prices to fluctuate until there is more clarity. 5. Global economic conditions. The U.S. doesn't operate in isolation. What happens globally affects the U.S. stock market too. A. Global growth trends. What is it? The economic health of other major economies like China or Europe. Why it matters: when global growth slows, U.S. companies that do business internationally may suffer, leading to lower stock prices. B. Currency exchange rates. What is it? The value of the US dollar compared to other currencies. Why it matters. A strong dollar makes US exports more expensive, which can hurt companies that rely on foreign sales. A weaker dollar can benefit exporters and drive stock prices higher. Market sentiment. Market sentiment reflects the overall mood of investors, whether they are optimistic or pessimistic. A. Bullish versus bearish sentiment. What is it? A bull market is when stock prices are rising, while a bear market is when prices are falling. Why it matters. Positive sentiment can push stock prices higher, while negative sentiment can lead to sell-offs and declines. B. Market volatility, VIX. What is it? The Volatility Index, VIX, measures market risk and uncertainty. Why it matters. When volatility is high, it usually means investors are nervous, and stock prices may fluctuate widely. New technologies can reshape entire industries, creating both opportunities and risks. A. Disruptive technologies. What is it? Innovations like artificial intelligence or electric vehicles that disrupt traditional industries. Why it matters. Companies that embrace disruptive technologies may see their stock prices skyrocket, while those that don't may struggle to keep up. B. Cybersecurity risks. What is it? The risk of cyber attacks on companies. Why it matters. A major data breach or attack can significantly hurt a company's stock price, especially in tech and financial sectors. Events beyond our control, like natural disasters or health crises, can have a big impact on the stock market. A. Pandemics, e.g., COVID-19. Impact. As we saw with COVID-19, pandemics can cause economic shutdowns, pushing markets down as businesses close and unemployment rises. B. Climate change and natural disasters. Impact. Hurricanes, floods, and other natural disasters can disrupt industries, especially those in energy or agriculture, leading to stock price fluctuations. How does inflation affect the stock market? High inflation often leads to higher interest rates, which can reduce consumer spending and corporate profits, negatively affecting stock prices. Why do corporate earnings reports matter? They give investors a direct look at a company's profitability. Strong earnings can boost stock prices, while weak reports can cause sell-offs. How do interest rates influence the stock market? Higher interest rates make borrowing more expensive, which can reduce spending and hurt profits. Lower rates stimulate economic growth, boosting stock prices. The U.S. stock market is influenced by a wide range of factors, from economic indicators to global events. By understanding these factors, you can make more informed investment decisions and better navigate market volatility. Keeping an eye on things like corporate earnings, interest rates, and geopolitical events will give you the tools you need to succeed in this ever-changing market.